this month. So, but I think I mean, you know how he was last time when he was on, and he's working through some things, I think.
Mhm. Okay, perfect. We are live, okay?
Yes.
Uh, yes. Good evening. Logistics Managers Index, LMI, with Professors Dale Rogers, Arizona State University, and Zachary Rogers, Colorado State University. Pandemic is still high, but LMI is recovering.
Yeah, that's right. So probably we should give, before we really start talking about it, maybe we could start giving your viewers a little bit of background in exactly what the LMI is. So I will project my screen here,
Sure.
and let's talk about the LMI, or the Logistics Managers Index. Okay, I'm clicking
Well,
on
and
share.
while Zach's calling it up, so the Logistics Managers Index is a group of let's see, eight indicators,
Yeah.
components combined together. And I'm at Arizona State, Zach's at Colorado State, Rochester Institute of Technology, Stephen Carnevale, who you've talked to before, Shen Yenyert's at Rutgers, and Ron Lemke is at University of Nevada, Reno. And we do this in conjunction with the Council of Supply Chain Management Professionals, which is the big logistics organization, professional organization in the US, and DC Velocity and CSCMP Supply Chain Quarterly, those two magazines. So we do this every month, and it seems like it's been very predictive. So just to set this up a little bit, a lot of economic indicators, and maybe we've even talked about this before, a lot of economic indicators like gross domestic product, like GDP, that really measures what's happened right before, say, the retailer or whoever is the last mile as they sell to the consumer. And so it tells you what already happened. It doesn't tell you, it doesn't measure anything upstream. And Cavania, as a former procurement guy, maybe once you're a procurement guy, you always are. So maybe it's not former, but as a procurement expert, that there's a whole lot of economic activity as a purchasing guy. You could see upstream in the supply chain before it shows up much later in GDP. And so what we're doing is similar to the Purchasing Managers Index, and we are measuring 8 things, and inventory, transportation, pricing, costs, utilization, and warehousing pricing. I said that wrong. Transportation, pricing, utilization, and capacity. And the same thing with warehousing, and then inventory, uh, uh, costs, as well. And we break out each of those components separately, and then we also show them as a combined metric that we call the Logistics Managers Index, the LMI. And we ask people for all 8 components, is it staying the same? Is it decreasing? Is it increasing? And then we turn those answers. So if they say decreasing, we give that component a 0. If it's staying the same, we give it 50. And if it's increasing, we give it 100. We average those together, and then we get a number, which is usually clustered around 50. But this past month, June 2020, we saw some really interesting things.
Right. So
So,
here's
Zach,
sort of, oh, go
Zach,
ahead.
Yeah, so it's a kind of a forecasting economy based on logistics metrics, is it?
Correct.
Exactly. And so the idea is that before anything can get bought, right, before you can walk in a store and buy something off a shelf, it has to be placed on that shelf. How does that happen? It has to be stored somewhere in inventory, probably in a warehouse, has to be moved. And so usually what we see is some movement. So when there's movement in, say, freight prices or warehouse capacity, generally that's predictive of future economic activity. And so you can't really have that endpoint, that final consumption that something like GDP or GNP would track without the logistics activity happening upstream. And our analysis that we've actually done, so we've been doing this since September 2016, so about 4 years. And analysis of sort of our long-term numbers shows that the LMI is predictive of next month's economic activity. So LMI in July usually can tell us about retail sales, Dow Jones, unemployment in August. So it's very predictive in a way that a lot of economic indicators are not. And just like we said a second ago, it's a simple kind of survey that we have people do. It's a diffusion index, which is the same thing as the PMI. Okay, and so basically we have these 8 metrics: inventory levels and costs, warehousing capacity, utilization and price, transportation capacity, utilization and price. And we say going up, staying the same, going down. Take an average of that. Now, any number that we get over 50 indicates growth relative to, the last month, basically, right? So we have growth. Anything under 50 indicates contraction. That's the whole survey. And like I said, we've been doing it for almost 4 years. We'll be 4 years this fall. And we have almost 4,000 responses to this over the lifetime of the survey. Usually we get somewhere between 100, 150, a few times 200 responses every month from director level and above is what we look for.
Zach, what's the meaning of the number 61.7? Means exactly what?
Great question. Okay, so the 61.7 from June of 2020 essentially means that the logistics industry is growing. And it's growing at a faster pace than it has essentially since February of 2019. So we haven't seen this rate of growth since February of 2019. Now, does that mean it's as high as, trucking prices are as high as they were in February of 2019? No, there's probably about 90,000 less transportation jobs today than there were then because of the shutdown. But relative to where we were, we're starting to climb back out of the hole. So you can see that in April, we hit the all-time low point of this index. We're at 51.3. And essentially what 51.3 means is no growth. Remember, 50 is kind of the break even. So 51 doesn't really, that basically means we're not moving, is what that means. And the only reason that it wasn't negative is because inventory levels in the upstream supply chain were really high. So we brought inventory in with the anticipation the economy was going to be open. It shut down, and then we couldn't move this inventory. And so we were at 51, basically no movement, no growth. And now going forward to May, June, we start to grow. And in June, we hit 61.7, which is the fastest rate of growth we've had in almost a year and a half. Now, again, that's not, the level is not as high as it was a year and a half ago. And we're not sure what the sustainability of this number is. So we have, if you've been following the news in the US, Arizona is going to shut some things down again. Florida and Texas and parts of Southern California are having similar problems. And so this could be a spike and then we go back down. We're not sure exactly what the recovery is going to look like. Right now, if we stay on this course, it's kind of looking like a U. There's a chance it could look like a W, which obviously we wouldn't really want. So let's break down then. So overall, it's okay. It's 61.7.
Before Zach,
Yes.
before you go break down, the index start decreasing before the pandemic arrived.
Yes. Yeah, that's absolutely right.
Let me talk to that because I think this is really interesting. So if you look at the months, a lot of summer, certainly late summer, fall of 2019, before the pandemic hit, we had been seeing an overall decline in the upstream economy. Now, the Purchasing Managers Index, which is also done here where I live here in Arizona, the Purchasing Managers Index saw lower readings. They use a similar index to us. They saw lower readings because all of their, most all of their stuff comes from business to business purchases. And we have both business to business plus consumer in here. Now, the consumer, I mean, you always hear President Trump talking about this. The consumer has been a really hot, it's been a hot part of the economy the last several years, way before the Trump administration, truthfully. But we in our LMI, we're picking up both retail numbers and also third-party logistics numbers and other kinds of companies. So our numbers didn't decay as much in late 2019 as the PMI did, because we have both upstream and downstream. And I think, I don't know for sure, Zach may have a slide with the upstream, downstream on it, and you can really see the difference. Oh, it's the next one. So this kind of tells you, this is really for June of 2020, right?
And this looks a lot different than May and April did.
But for instance, upstream transportation pricing were increasing more than downstream was. The downstream is the orange and the upstream is the blue. But for most of the last few months before the pandemic hit, we were seeing a real decline in upstream activity, while the downstream, right before from the retailers and whoever else to the consumer, that was still very strong, right, Zach?
Yeah, absolutely. So especially if we look at things like inventory. So if we look at, okay, so COVID hits, what happens? Inventory downstream drops precipitously. We're starting to get negative inventory growth downstream, very high inventory growth upstream, and almost no warehouse capacity upstream. Why is that? It's because, okay, we can't sell anything in the store because we're shut down, make the supplier hold it. And so that's what had been happening March, April, May. In June, we see a difference. So the metric on the very bottom of this slide, inventory levels. In May, upstream, so away from the consumer, was at 60% growth. Downstream was at exactly 50, meaning there was no movement downstream. They weren't adding inventory. They were basically staying at a steady state because they were frozen. Look at this month. Downstream is at 65, upstream is at 64. So they're both up, but downstream is up by 15 points. And it's because everything opens back up again. And we see the same movement with transportation. Transportation for downstream last month was in the 40s somewhere. And now it's way up again into the high 50s. And it's because the downstream economy is open again, and the upstream economy isn't having to hold all of that inventory in place to the same extent. Now, they're still tight. If you look at warehousing capacity, overall warehousing capacity, you can see both those numbers are below zero. That 37, though, on downstream is about the lowest number we've ever recorded.
They're below 50, not below zero, but they're below 50.
Oh, sorry, below 50, yeah, below 50, yeah.
So what that means is it's decreasing.
And 37 means extreme contraction.
Right, that's a really low reading. And that says when you average all the responses together, so there's three possible responses: 0, 50, 100. So they say decreasing 0, staying the same 50, increasing 100. And so we average all that stuff together, and warehousing capacity is really tight, particularly downstream, which would be a lot of retailers, because the stores aren't really open yet and nobody's really buying stuff from most retailers. Grocery retailers health and beauty aids, those kind of guys are doing fine. But you've probably seen all the bankruptcies we've seen up here on in the retail sector, and
especially apparel, electronics.
Right, and that inventory isn't moving, and so it's sitting in a warehouse somewhere, and so we're sort of constipated. The warehouses in the U.S. are pretty full right now, so so the respondents are saying, look, I'm having troubles finding capacity. It seems like it's decreasing, and that's what that number says.
So inventory levels for downstream is bigger than for upstream. It means that.
Oh yeah, sure. I can go back for you here. So inventory levels upstream are up. Well, the growth rate is higher. So there may be more inventory upstream still, but because upstream inventories are already so high, they just might not be growing at the same pace as downstream.
Right.
But inventory is very high in both, and the rate of growth is higher downstream, and that's a real big change. I mean, you know, downstream was 10 points lower than upstream in May, and this month it's a point higher, which is a very big swing. We don't normally see giant swings, especially in something like inventory levels. So to have a movement like that shows that a lot is happening and a lot has changed since May. So I think this is kind of a natural transition into the next slide here, and so now we're splitting apart. Whoa, hey, we're no longer splitting apart upstream and downstream. We're just looking at the total LMI, and you can see inventory levels at 64.3, highest we've had since last summer, since July, and that's driven by the buildup of inventory we had pre-COVID and the inability to get rid of it, and the fact that we've brought some more inventory in because some places are slowly starting to open up, and I think some stores were bringing inventory in with an anticipation that they would open up, and now maybe that's not happening. And it's interesting because I think this goes along with what you were saying about Cavani, the LMI, the low scores we had last year. You could see that inventory had kind of been trending down. If you look at the mean score for 2018 versus 2019, clearly in 2019, we had a lot less inventory on hand. And I don't know if you'll even remember, you know, in January and early this year, companies were talking about, hey, let's burn down our inventories a little bit. And so that's kind of what we see. December, January, February. In December and February, we see negative growth. So we see inventory starting to contract. And then we hit COVID, and suddenly it starts going way, way up again. And this has an impact on warehousing capacity, which is the graph to the right here. And you can see that warehousing capacity down at the overall score, if you combine the two, it's 41.7. That's the lowest number we've had in the history of the LMI. So we've never had a harder time finding warehouse space, finding available warehouse space in the US than we're having in June 2020, at least as far back as the LMI goes, September 2016. But in those 4 years, warehousing space has never been tighter because we just have an absolute glut of inventory, and then there's nowhere for it to go. You know, if you're a big apparel company and you built up all your spring, you know, line, or your spring clothes, nobody bought the spring clothes. And so now what do? Well, you have to bring in summer clothes if you think you're going to open again. And a lot of us thought we were going to open, or maybe we're opening online or whatever. And what do you do with the spring stuff? Well, some places are kind of trying to shuttle it into the secondary market, but the secondary market can only take so much. And so we have a lot of firms who are just saying, you know what, we're going to store it. And this year's spring line is going to be next year's spring line. And so we have companies almost carrying, especially in apparel, carrying like a double quantity of inventory, or maybe, you know, 1.5 quantities of what they would normally have right now. And that's really squeezing warehousing capacity in the U.S.
May I ask you, people can can make decisions based on this index? And the second point, how many months in front can we see in terms of forecasting or prediction?
Well, I think absolutely. You know, if we try to get it out the first Tuesday of every month, so these numbers came out today. But if for some reason we're slower than that, we hear from a lot of people saying, hey, let us know what's going on, because it is sort of a look into the future. So it's, I mean, I think it has become a predictive thing, and it tells you what's likely to happen sooner than some other indicators. Um, uh, as to your second question, we actually ask them for their estimation of 12 months in the future. And for a while, it's kind of off now because of the virus, but we actually had incredible, you know, what we found a year after the 12 months predictions a few months ago were they all came out exactly the same. It was surprising to us. So
wow, this picture is fantastic. So you can see 12 months in front.
This is the prediction.
Yeah, so we're asking people what they think is going to happen in 12 months. So it's sort of wisdom of the crowd, Cavania. So we're saying, look, you logistics professionals, what do you think is going to happen on each of these things 12 months from now? And of course, not everybody knows everything, and no one forecasted COVID-19, but certainly they are pretty predictive about what's going to happen in 12 months, and it's been really interesting to follow this.
And you can see from this picture they're forecasting growth. So in the next 12 months, and who knows, you know, but whether this is what is going to happen or just what people hope is going to happen. Those are hard to disentangle sometimes. But if, you know, as of right now, they're predicting big growth in both warehousing price and transportation price. Now, I don't know if I don't know. I may not be as optimistic. I think what this assumes is that we're going to end the lockdown and the economy will sort of start to come back. Because the economy, once the virus is handled, the economy should be able to come back relatively quickly. Now, it won't come back right away because there's some infrastructure stuff that we're going to have to build back in and some labor that we're going to have to replace. But I think the idea is that, well, 12 months from now, if we have, you know, vaccines in January, and who knows really, but, you know, if we have a vaccine in January, maybe we could see the sort of growth that we were seeing in 2017 or 2018 in 2021. Now, this recession could end up becoming a real recession and going a little longer. We don't know. But when we asked the crowd, the respondents, to predict what they thought was going to happen in the next 12 months for June, this is what they gave us. And it's important, I think, to note that the predictions here do fluctuate quite a bit. You know, this is much more optimistic. The future predictions for June are much more optimistic than what the future predictions were in May. So, you know, you know, these numbers move quite a bit.
And I think it's interesting because one of the real takeaways from this picture, and who knows, we'll know in June 2021 if they were right. But one of the biggest predictions, I think, is that warehousing capacity will be less of a problem than it is right now, because we'll have been able to move some of that inventory. But transportation is going to be more difficult to find. Now, that's close to 50, but that's the lowest. That's the lowest one. And they're also thinking that people are going to be able to charge more for both warehousing, transportation, and that the cost of purchasing materials and inventory is going to be higher. And I think you can read a lot into that. It could be that you know, folks are thinking, look, we got to source from other places besides China, and so that's one of the reasons inventory costs are going to go up. But there's this belief that as we get through the pandemic in a year, I don't know if it's right or not. Nobody does, but that we're going to see increases in all those costs: inventory, warehousing, and transportation. And that gives you a feeling for what companies think they're facing. They might be wrong, and we'll know in a year, but this is what they think they're facing.
Dale, you made this statement based on the transportation price 75.4. Is this correct?
Correct. That means growing very quickly. So that means, I mean, I'm sure there was some decreasing respondents in there, but it's almost exactly right in between staying the same and increasing. So by far the majority thinks that it's probably increasing.
But maybe inflation or costs, transportation costs for let's see, trucks.
Well, I don't think anybody here believes there's going to be much inflation, particularly now. We really haven't seen hardly any inflation, Cavagna.
Okay.
You know, look at what the Federal Reserve has done over the last 3 or 4 years.
Yeah, reducing the interest rates. Yeah.
They haven't jacked the interest rates up because there really hasn't been much inflation at all.
Yeah, that's right. That's right.
Now, one thing that could cause this is consolidation. So if we start to see firms go out of business, like on the trucking side, we've seen a lot of small 3PLs have issues. And so if we see small 3PLs start to disappear and get consolidated into some of the bigger firms, then pricing could also become less competitive. And you can see the same thing happening for suppliers. Small suppliers go out of business, and you see more consolidation. There could be less price competition, and that could also be a factor here. But really, if I'm looking at this and in the context of the rest of the report, people are just expecting the economy to come back. That's what this number says is things will hopefully be better in a year, and things will start going back up the way that we liked it back in 2017 or 2018. Now, I think it's interesting to point out that of all of these metrics, almost the most consistent with what's going on today is transportation capacity. Here it was a 49.6. And if we look at our slides, 49.6. So I think, or maybe it's 49.5 and 49.6. It was off by 0.1 from what it is today. And so transportation capacity is low right now. It's basically not moving, a little bit negative.
Yeah, that's basically.
Yeah, and you can see that's a big change from April.
But how can you have a decrease of transportation capacity if the number of trucks and other models?
So it's available trucks. So you can have more trucks, but less of those trucks are available because there's more freight on the road. And so that's what we're seeing right now. And if you look at things like Freight Waves, who's our friends, and we do quite a bit of work with them, they have something called the tender rejection index, tender rejection rates. And the tender rejection rates in June were very high. And basically what that says is that carriers had a lot of options, and so they could reject, I offer you a load to take, yours isn't that good, I'm going to go with this person's over here. And so that creates a rejection, and the higher rejection rates are, the sort of busier we the truck. And so we can see that trucks got very, very busy this month, or much busier than they had been. And let's see, when was the last time? I guess in March, we had this sort of weird spike. You can see it was 47 in March. That was just because that's right when everything locked down and everybody scrambled to get toilet paper and soap and hand sanitizer. And we had this weird spike in the middle of 2 weeks of March. But throwing that out, we haven't had capacity decrease since October of 2018. And so again, what that shows is that we sort of had a slowdown in a lot of the economy. And now as we start to open up again, things are picking back up. You see the same phenomenon with transportation prices. Again, if you throw out March, because that was sort of an aberration, our transportation prices are growing at a faster rate than they have since March of 2019. And, capacity and price, of course, are sort of inversely correlated with one another. But we really see a spike in transportation price growth. Now, is it anything compared to, you can see July or August of 2018? No, it was growing at 92 in July 2018. I mean, it was just absolutely, we could not have enough trucks on the road. But I think the fact that over 15,000 heavy duty trucks were ordered in the US in June is a good sign and sort of speaks to what we're seeing here. Again, this is not a full recovery. This is in no way says that just because this says 64 right here, that doesn't mean, oh, we're back to where we were a year and a half ago. Mm-hmm. That just means that we're up quite a bit from where we were last month.
And Cavani, you can kind of tell from the slope of all the different curves of the components that transportation tends to move quicker than warehousing and inventory. And that would make sense because warehousing is more of a fixed asset and transportation is quite variable, can go up or down. So that you would expect that, but certainly transportation pricing can vary quite a bit month to month. The red line is the overall trend, but you can see in March when everybody was looking for trucks to ship groceries and toilet paper and all that stuff to the retail stores, people were scrambling looking for trucks. And then in April, hardly anybody really wanted trucks, and the pricing responded dramatically to that.
And the seasonal influence. I mean, we are in the summertime, so is there any influence in these results?
You know what? I was so well. You can talk to Zach, but I was so expecting when we started this that we would see huge seasonality, and there's a little bit of it, but I don't. I mean, we could go through the big influences. I mean, look at November and December from last year. If seasonality really mattered, you would have expected that leading into Christmas, the transportation prices would be higher and capacity would be much lower. And that's not what we've
seen. And transportation price especially is the most reactive to outside events. And so let me show you a picture here. Let's look at this. So let's, if we just look at this sort of graph here, okay? And you don't need to, so look at this. The red line is transportation price. The blue line is capacity. Remember, they work inversely from each other. Mm-hmm. When we saw the tax break in the kind of beginning of 2017 or beginning of 2018, right about here, look at price suddenly go way up and capacity go way down. And so this is a result of suddenly companies had a lot more money in their pocket. And now a lot of that was spent on stock buybacks, but not all of it was. And we saw prices go way up, capacity go way down. And then suddenly the trade war starts in sort of late 18, early 19, and manufacturing really slows down. When manufacturing slows down, we have an inverse. We're an inversion point here, where capacity is suddenly higher than prices.
So they lose money. Some of them lose money.
Yes. And trade was down, so we're not moving as much around. And then we move forward to March, and I actually split it out by early March and late March, because early March and late March were so different here, because we sort of had the panic in early March, and then late March we were all in lockdown. Mm-hmm. It flips again. And so you kind of saw prices go up, capacity go down. And then this month, these would have maybe flipped one last time, actually. So prices would be higher again. And so you can see that this is very dependent on outside forces. Mm-hmm. And so much more than seasonality, I mean, seasonality plays a role, but much more than seasonality, we see these big economic events or shifts in policy predict how transportation price is going to move much more than something like, oh, it's July. So we're moving a lot of stuff.
This picture is excellent, fantastic. Shows several good points to be studied. The tax break, the slowdown, the trade war, and the COVID-19. Fantastic. Tell me, Zach and Dale, please. The methodology is consists probably on capture data, and this is maybe the most important challenge you have, to capture data every month, I suppose. To treat this now an algorithm that you just have to calculate and to publish. So how do you capture data? What's the way you do that?
So this is a picture, this first slide we had of the survey. So if you open up the LMI, this is the picture you'll see right here. So we'll say inventory levels. Are they declining? Are they staying the same? Are they going up? Or let's say you're maybe a carrying company or somebody who doesn't see a lot of inventory, maybe. You can say, oh, we don't know. You can say NA, maybe. Although most people always answer inventory. We do have some folks that only answer maybe transportation inventory or warehousing and inventory. But most people, I would say, answer all three. And so basically we assign a score of 0 for declining, 50 for unchanged, 100 for increasing.
Okay.
We don't factor in NAs, average that together, and then we get a number for all 8 of our metrics. And then we use those metrics to develop the overall LMI. Now we'll do things like when we calculate the overall LMI, we'll invert transportation and warehousing capacity, because low levels of transportation and warehousing capacity actually mean that things are busy, right? So we'll flip those because capacity is negatively related to growth. But other than that, it's pretty straightforward. Now, in terms of collecting data, that is a lot of work, and the other Dr. Rogers is the main person who does that part, actually. But it's been nice because we have really, I think, and Dad, you can speak to this more, built up a big stable of folks who respond every month, and they look forward to this coming out. And we really, we couldn't do this without our respondents, and our respondents have been really great, especially over the last year, with being generous with their time and information, and allowing us to put together sort of a crowdsourced number that no one could do on their own. No one company could figure these numbers out on their own, and people have been very generous with letting us have their information, sharing their information, so we could come up with this sort of overall economic number.
Perfect.
Yeah, I think someone ought to do this in Brazil, and I've tried to talk some folks into doing that, but I think this would be a great tool down there, actually, because it really does show you, what's happening both upstream and downstream, and then also what's likely to happen in a year. I think it's a really nice tool, and as we've done it the last few years, and the predictions have come out to be true, I think people are more interested in it than they used to be.
Yeah, it's a good project. Yeah, no doubt. Yeah. Okay, thanks a lot. And let's go to the conclusions, please, professors, about LMI. What you wanted to say?
Well, we've said a lot of it already, but Zach, do you want to say something about?
Yeah, I would just say that, this month we saw the beginning of the comeback, I think, from the low points that we had hit in the US. Mm-hmm. Now, whether that gets backtracked a little bit because we may have things closed down again remains to be seen. I hope that we can start opening back up again, but the virus has to be treated, and you guys down in Brazil know this just as well as we do. The virus has to be treated before the economy can really come back. Mm-hmm. Now, that being said, the LMI is higher than it's been in quite a while, and it's usually a good predictor of economic activity. So if we don't have any sort of external interruption, like, we're shutting Texas back down, I think we're slowly starting to come out of the hole. We're not back to where we were, but maybe we've bottomed out, and we're going to start the sort of slow climb back up. I don't think it's going to be a V shape. It's, maybe going to be a U. Again, hopefully not a double U, because that would be bad. But it seems like we're starting to come back, and this is really driven by increasing inventory levels, increasing transportation prices, low warehouse capacity. Now,
Well, and also I would say that that as we were heading into the last months of 2019, you could see an overall decline.
yeah,
If the stuff would not have happened with the virus, I don't think we'd be seeing that upswing. I think we'd be
No.
seeing still on that glide path
mhm.
down because we
Yeah,
were
if you stop it right at February of 2020, you can see we'd been on a solid path down.
yeah, and if you think about what was happening, I mean, I don't know, Cavani, if you follow this, but like for example, the September 2019 corporate earnings and the December 19 corporate earnings for FedEx, as an example, were much lower. They missed their estimates in both the third quarter and fourth quarter of 2019. Well, how come? President Trump, a lot of people thought we were in this really hot economy, but the underlying upstream economy, all those purchases were slowing down. And that's what FedEx and UPS and all those guys ship is mostly, I mean, they do the to consumer, but also all that upstream stuff. And you were seeing a slowdown there. And what happened as we went into the virus, that some trends got accelerated. And right now, and we don't know what it'll be in 5 or 6 months, but it looks like that we got through some of that hard stuff faster than we would have expected. There was a real run on several commodities that are important parts of the U.S. economy, and that's actually revitalized some of the logistics components. Now, also though, many things aren't selling, and so we're constipated with inventory. There's stuff just sitting around. So that's another part of this. But if we wouldn't have seen the virus hit, I think we would have been on a steady decline going into the November presidential election.
Yeah. Really what the virus did was act as a catalyst and speed up trends that were already there.
Right.
So we were slowing down, and then this really slowed us down. Even if you look at a more micro level at industries, companies that probably would have held on a little longer, like in the US, say J.C. Penney's, Chuck E. Cheese, bankrupt now, right? So malls are going out of business much quicker than they had been. Now, these are trends that already existed, but now this sped them up. And it also speeds us up on the other side, right? Suddenly Amazon, Jeff Bezos, I think he's $25 billion richer than he was.
It's a trade-off. It's a trade-off.
Yeah, right, exactly. And so the companies that were going to grow anyway, these sort of convenience companies, Uber Eats just bought, I think Postmates yesterday for a ton of money. So these sort of convenience, these delivery, the way the economy is going anyway, it's been like rocket fuel for them. And for the old school companies, the companies that are the big, in the mall stores, those are where we're slowing down. So really all this COVID did was get us to where we were going faster. Now, and hopefully we'll also get to the recovery faster.
Is it reversible or irreversible?
Well, you could see from the slopes it goes up and down. So I think some of it's reversible, but the truth is that there's some companies.
But department stores aren't coming back.
Yeah.
Right. And here's what I think, Cavani. In the U.S., last few years, we were seeing about 10,000 retail stores closed per year. And this year it's going to be a lot more, somewhere between 30 and 50,000 probably.
Wow.
So we've just increased the rate at which some of these things are going to happen already.
So they are concentrating in big companies instead of small ones.
Look at, and this has a ripple effect, obviously, with commercial real estate and so on. But there's a bunch of empty spots in malls that what are they going to do with those malls? There's nobody to fill them up. I mean, I know when you come to the U.S. and you go to a mall, you walk around and you see, okay, that used to be a brand. It used to be Abercrombie and Fitch or Hollister or something, and now that's an Asian gift store, which is probably a one-off kind of thing, and you can tell that the mall's starting to decline, you know.
Right.
And so we're seeing a lot of that, and then the mall totally goes empty and is dead.
Yep. And once you lose a couple of the big box stores, that's when it really goes. And you know,
Right.
Macy's, JCPenney, Sears, the stores we've lost a lot of. Once you lose 2 or 3 of those in a mall, it can trigger the contract of the smaller stores, and they can just leave. And so it gets them into a death spiral really quickly.
And how is China in this game?
Well, China doesn't have as many places to sell stuff to as they did a few months ago because, for one thing, there is already a migration in the US of moving out of China as a source. Now, some of it's because of the Trump trade war, but really it was happening before as
They're becoming a middle class.
yeah, and it was becoming too expensive. So, like over the last 10 years, we've seen about, you know, for instance, China is where most of the footwear in the world comes from. So, I mean, it used to be Italy and Brazil and not so much anymore. And so China is about 90% or so 10 years ago of source of footwear. And over the last 10 years, it's been about 1% moving out of China and mostly going to Vietnam. Now, Vietnam isn't a very big country. It doesn't have a lot of potential capacity, but it's really benefited from the increased prices in China, then the trade war, because we don't consider them the same thing as China, and then the virus wasn't really good for anybody. But we've really seen a migration out of China, and many big American companies, and I think Brazilian companies as well, are thinking about what should our strategy be around risk, because we probably need to have some redundancy. So maybe we're mostly sourcing from China, but given how many supply chain disruptions there's been in the last 10 years, you think about it in the US for sure, 2017 was a terrible year for hurricanes. And, you know, we had the tsunamis in Japan, which affected us, and all these disruptions, which were really regional, truthfully. And then this COVID-19, which has been global. But, you know, companies are thinking, look, in order to ensure supply, we've got to hedge a little bit, and we need to build some. I mean, if you were back at Petrobras doing procurement, you'd be saying we've got to be hedged now.
No doubts. Normally we did 80-20% of the demand, separating 2 different sources. To
Right.
not be on one hand only is very, very dangerous to be 100% in hands of one provider only.
Right. And so now companies are thinking, well, it's not just companies we want to diversify because of risk, but now it's regions. Now it's China versus Mexico versus wherever else, you know.
It has to be a portfolio.
You're right. And I think in Brazil, the idea of reshoring is more realistic than the idea of reshoring here in the US.
In the US, it would be nearshoring, which is why
because the price, the costs are too much higher, no?
That's right.
It doesn't make sense, especially when Mexico is right there and you can be here in a day and labor is so much cheaper. Yeah, so I you know, it's the dream of it being 1925 and we're all going to work in factories again. That's not real. It's a fantasy.
Excellent. Okay, guys, thank you so much. We appreciate having Professors Dale Rogers and Zachary Rogers with us today. It was a pleasure for me.
It's always fun.
Yeah, it was great.
Thank you. So bye-bye and have a good day.
Yeah, right. Stay safe down there.
Yeah, good. Thank you. Bye. Thank you.